All right, guys, thanks for tuning in. We are just in the middle of more hot topics, and we were talking about, headlines in the news. Mortgage application activity index falls to the lowest level in 22 years. And guys, what that means is that we're seeing that consumer confidence buyers are pulling out. We've seen articles like 78% of the buyers have exited the market. We are seeing houses like mad. Just really with price reductions everywhere. We're seeing more inventory. We're seeing where sellers are going, man, we probably missed it. Maybe we waited too long. We're seeing more inventory hit the market across the country. And the biggest thing that we're seeing, guys, which is really, a telltale sign, as we've said in previous videos, we're seeing more back to actives where the offers are going in, the buyers are getting some type of remorse, finding out things in inspection, and they're looking at whatever the reason is as the house isn't worth the money that they originally offered. So they're backing out. Houses are going back on the market.
Yeah, and we just had a phone call today with one of the lenders that we know quite well. And she didn't say it, but we could sense it, that business is not what it used to be. So things are changing, and her tone said it all today.
Guys, if you're new to our show, I'm Todd Sachs. I'm a real estate broker here in Maryland, and I've been serving the housing industry in one aspect or another since 1989. So, coming to you with lots of years of experience through the ups and downs, through the history, and, not saying that things are falling apart, but we are facing some critical times here. The Fed is contemplating raising the rates yet again. We're looking at home mortgages today are anywhere from 30 to 50% more in monthly payments, depending on your credit, depending on your money down and where you're buying, and what type of loan, than it was just a year ago with the increase in median home prices and the rising in rates. And, one of the things that we want to talk about here is the actual box that I guess that the federal government is kind of boxed into right now with, how to get us out of this, how to prevent, a major recession, a major economic downturn in housing. So we're going to turn to what is called mortgage-backed securities and kind of define that a little bit for you, in these next couple minutes. Now, guys, one of the things before we start talking about mortgage-backed securities, because I want you to understand, the sort of like the financial backside of this, and it can be very complicated. We don't want to do that, but I just want you to understand a mortgage-backed security is exactly how it sounds. It's where, investors buy loans, buy mortgages that are backed by the asset. So in this case, what we're talking about is the house. So a couple things have to make sense in order for it to be an investment for the investors. So you can just think about it from your own standpoint. If you're going to part with your cash, chances are you're going to want some kind of a return on your investment. So what happens is when interest rates get really, really low, for example, in the mortgage business, when we saw buyers buying mortgages or buying houses for, let's say 2.5%, which was kind of like the absolute bottom, but certainly under 4%, which has been historic lows since home mortgages, since we've been tracking them back in the 60s. When we saw these low rates, the only one that would really offer it was the federal government. And the only way that they could do that is really lower the Federal Reserve's lending rate to zero, so that it sounded like a good idea to lend to mortgage-backed securities to borrowers buying houses at rates of less than 4%. Where, if you were talking to an investor and you said, hey, you want to lend me $350,000 at 4% for the next 30 years? As a investor, if I had the money to lend you like that, I'd probably say, that doesn't sound like a good idea. And then what they say is, yeah, but most people move in 7 years or 9 years. And then I'd have to sit there and say, with the way the home prices have gone up, where do they move to if they sold their house? Or with having a mortgage at 3.75% or 4%, why would they want to sell that and buy another house? I may be stuck with that mortgage for 30 years. So what happened is the government had to step up we had an issue with the pandemic where, the government tried to do the best that they could for us, keep our economy moving in a pandemic. I've never gone through a pandemic before. You probably haven't either. But what they said was, we need to keep the economy moving. So they went from like 1.7 trillion of mortgage-backed securities on the Federal Reserve's balance sheet, central bank's balance sheet, to now they're at 2.7 trillion because they wanted to keep things going. They wanted to keep the money flowing. So they lowered this rate that they would lend money to at a ridiculously low amount that investors, private investors, just kind of backed out. Now the Federal Reserve, they're kind of boxed into a corner because with that low rate, our prices have gone out of control. And we've seen that our median home price over the last 2 years has gone on average up almost 35% in 2 years. So when we look at those kind of runaway rates, and then we look at, wage growth that's lagged way behind that at maybe 4 or 5%, we're in a real situation where the affordability, now that rates are going up, it just doesn't support these high home prices. So what the Fed is saying is that, look, we're going to start getting out of the mortgage-backed securities business. And then, by the fall, hopefully we're going to be taking this $2.7 trillion mortgage-backed securities on the Fed's books, and we're going to reduce that by up to $35 billion per month. Well, the issue is that to slow the economy down and to really bring the rate of inflation into a normal, acceptable, rate, they have to raise now their Federal Reserve lending fee, or that percentage of interest rate. They got to raise that rate from 0 to somewhere around 3.5%. Well, when we saw just 75 basis points in the last 2 times that they raised rates, a quarter of a point, a half a point, now we saw home mortgages go to that 30% to 50% more with median home prices now elevated. Just a year ago, it's really taken the housing out of the affordability range. The problem that we have here is now they have to slow this rate down and protect the house prices, because if we see a crash in the housing market and we have $2.7 trillion in mortgage-backed securities, if these housing prices fall out, we're going to lose a lot of money. The Fed's going to lose a lot of money. And though they may be just thinking they'll print more, it's going to be a real economic mess if that were to happen.
To me, what this seems is that the Fed is avoiding the inevitable. We know what's going to happen. All signs really are pointing to yes. They're being cautious. They're being super careful. And they're kind of just tiptoeing around the whole issue where we all kind of have a feeling, but we know what's coming.
Yeah, well, this is the situation. So most of the economists are saying that this is not going to be a repeat of 2008. They're saying things like, our economy is actually not in that bad a shape, that we've got more money in our bank accounts than we've had in many years. But we know that the bank account, the savings rate is dropping really low, to less than 4% or somewhere around 4% nationwide that people are able to save. Where in the pandemic, when they were getting propped up with stimulus money, they were saving over 20% of their money was going in the bank and savings accounts. We had an economist told us that, economic outlooks, their forecasting is always born to fail, born to die. They have been in business for 70 plus years, this particular firm. And they said they do these economic forecasts, but, the real driving force here is you and me. Us buyers, us consumers, right? When we start pulling it back and we start, saying enough's enough, we need to worry about our necessities. We dictate, through our confidence index, our own inner confidence index, we kind of dictate, whether we're comfortable in spending our money and where.
So Todd, as we just discussed earlier, the Fed's meeting next week, the 14th and 15th. What's your take on it?
So, Melissa, there's one of two things that will happen come June 14th and 15th, and we're here to find out about it in a couple days. I think either one, the Fed is going to determine that, that 50 basis points helped but wasn't enough. And they've already alluded that we've had more job creation and that, things are still happening despite the rise in interest rates, still a runaway train, and that they feel that they need to do it again to kind of slow it down a little bit more. Or they may, because we've got midterm elections coming up, we've got mortgage-backed securities here, they've seen the pullback. I mean, they know what the pullback is in the housing market. And if they raise these rates again, it's going to be even more pullback. So what they can do, which I believe may be the case, is they may say, because of the elections coming up, because of mortgage-backed securities and wanting to get $30 trillion a month off of the Fed's balance sheet into private equity, having this private money buy these mortgage-backed securities, they may say, you know what, everything's worked great just like they planned, and that they don't need to raise the rates again right now, and that they may revisit it again for future time. So that's kind of what I'm thinking, just basically by seeing the way that the market has behaved since the last hike and the major pullback. I think that they may try and give the buyers a little bit more encouragement, a little bit more sense of security to still buy a house, to still go out and do it. I think if they did that, actually, it would be brilliant, because I think that the last month has taught the sellers a lot. I think that it's taught them that it's not practical to be selling their home that they've deferred maintenance on with no inspections. I think it's impractical for them to believe that people should pay 50, 60, 100,000 more than the appraised value, and just saying that the appraisals haven't kept up. The reason they haven't kept up is because it's growth that's not sustainable. So I think if the Fed were to come out and say, you know what, we're going to hold the rates where they are, it will give the investors the confidence to pump money into mortgages, because they're going to get a little bit more. They're not going to get 3.75. They're going to get 5.5, 5.75%. It's still cheap money. It'll balance out the houses a little bit. And at least that's what I'm hoping that we see.
I am too. I'm hoping that. And if they can play it safe and keep things where they are, yeah, absolutely.
So guys, if we haven't lost you with all this mortgage-backed securities talk and you like this video, you can give it a thumbs up. It'll let Melissa and I know that you did. And I always appreciate when you hit that subscribe button and the alert bell, so that when we upload more content, you'll be sure not to miss it.
Keep those comments and questions coming. Until then,
see you next time.
See you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.